And this brings us to our discussion on the covered call. The covered call is one of the safest option strategies that you can implement. And because of that, it's a favorite strategy of many hedge fund managers and veterans of the world of trading. I think you're going to love it as well, especially if you're an intermediate term trader or a longer term trader, a trader who really likes to buy stock. This is a great strategy and a great addition to your basket of strategies in terms of how you can grow your account and bring in consistent cash on a monthly basis. Let's look at it a little bit closer. One of the reasons this is a very popular strategy is because, as I've mentioned, it's considered a relatively safe strategy. In fact, if you do it the way that most people do it, it really does not incur any additional risk than what you would have taken on with a typical long trade. When you buy stock, the risk is that the stock would go down, but when you sell a covered call, you simply are bringing some additional cash in, and you're not taking on any additional risk beyond the risk that the stock would go down. So this is a relatively safe strategy that most people are pretty comfortable with. In addition to that, this particular trade can be used in most types of personally managed accounts. What I mean by that is most IRAs have limits. They may not allow you to sell a stock short, or in some cases do some of the more advanced option trades that we teach you how to do. However, the covered call, because it's considered a safer trade, is allowed by most of these accounts for you to do on your own. And so it's a great strategy, again, for a lot of traders. This is a classic strategy of what we refer to as a safer investor. Investors who want to make some more money, but they really don't want to take on any additional risk than the simple buying of a stock long. And if that describes you, then this may be a great trade for you. And not only all of these wonderful features, but it's also an easy way to make some extra monthly income from the stock that maybe you already own or stock that you're planning to own. Let's look at how the covered call is created. In order to sell a covered call, you must own the underlying shares. Now, you could have owned them for many years, you could have owned them for just a few seconds, but you must own the underlying shares of stock in that company that you're going to be selling the call against. If you do not own the underlying shares, then you do not have a covered call. You would have a naked position or an uncovered position. But we're going to be talking about the covered call. And so to be covered, you must own the underlying stock. And for every option contract that you want to sell, you must own at least 100 shares. If you want to sell one contract, you must own 100 shares. If you want to sell two contracts, you must own 200 shares, and on, because as we've already discussed, each option contract holds 100 shares of the underlying stock. Now, assuming that you do own those positions, what do? Well, you can turn right around and you can sell the call options against those positions. After you buy the stock, you turn around and sell the call option. It could be immediate, or it could be at another time in the future. It doesn't really matter when you do this. You can just sell the call option as long as you own the stock. Now, the call is going to give somebody else the right to buy your stock. Remember, a call option is the right to buy the stock. If you're selling the call, then you're selling that right to somebody else. And of course, you're going to get paid for that call option. That's the premium that you're going to receive for the option. Now, in the process, you become obligated to sell the stock at that price if the buyer wants to. The buyer does not have to exercise the option. They may choose to. They have the right, but not the obligation. You as the seller, you are obligated to sell at that price if the buyer wants to. It's out of your control. You've sold those options to somebody else. Let's take an example here, and let's look and see how this could work out in your favor. Let's say that you've got a stock that's just trading along here, and it's rallied up to, maybe $100 a share, and it's pulled back down to maybe $90 a share. We'll write 100 here and 90 down here. And then maybe it's rallied back up to the top, but it's starting to pull back down, and you're concerned that it's going to start heading down. Now, for the purposes of my story, let's assume that you purchased it back here at 90. So we'll put BOT, that's a very bad abbreviation for bought at 90. So you bought it back here at $90 a share. We do have some support here. We've got some resistance up here at 100. Now, as the stock starts to come down, you're concerned that the stock's going to sell off, or maybe you're just kind of tired of the stock not rallying and you'd like to make some money on this thing. So what are you thinking? You're thinking, well, I could sell it at 100, or I could hold it until it hits 90 and maybe bounces again. Maybe you're just not sure what to do. Here's one possibility of what you could do. You could sell it at 100, or you could sell the call option to somebody else to buy it at 100, or let's take it on up one more level. What if we sold the call option at 105? So let's say you sell a call option at 105. You're going to sell somebody else the right to buy this stock at $105 per share. Now, once you've sold somebody this right to buy the stock at $105 a share, you receive the cash, and I'm going to make up a dollar amount and say that you receive $1 per share, and you also become obligated to sell. So we'll just put up here, obligated to sell at 105. Now, this isn't a big deal for you because you purchased the stock at $90 a share. Had you purchased the stock at $110 a share, this might be a negative transaction for you, but you realize even if you have to sell the stock at 105, you're not going to lose money on this trade. That's why they say this is a fairly safe option strategy. So let's look and see what could happen here. If, and here's a hypothetical scenario, if this particular trade trades back up, and maybe gets stuck at $100 and comes back down or gets stuck around through here. If that happens, then here's what your scenario is. You bought the stock at $90 a share. The person, whoever it is, pays you $1 per share, which we will call OP for option premium. And since the stock has not rallied above $105 per share, there's nobody that's going to want to pay $105 a share to actually buy it from you. So you're going to keep 100% of that premium, the entire dollar of that premium. How do I know nobody's going to pay 105? Well, I don't think you're going to pay 105 if the stock's trading in the $90 range. So if you're not going to do it, well, neither is anybody else. They're not that crazy. Anybody would rather pay less on the open market than to exercise their option where they would have to pay more. It just doesn't make sense. So as long as the stock closes at expiration below that 105 mark, you're going to be realizing 100% of this premium, in this case $1. Now let's assume for a minute though, that would be my red line. Let's take my green line here, and now we'll use my yellow line. And let's say that the stock, whenever it got to $100, if it kept rallying, and maybe at expiration it had rallied on up to $108 or $110 a share, well, you're going to get called out. The person who bought that call option from you is going to exercise it, and they're going to say, I have the right to buy this stock at 105. It's currently trading for more than that. I'm going to buy it at 105. Well, that means you're going to sell it at 105 because remember, you are obligated to sell at 105. So let's look at the math on that. In this particular scenario, you would have sold the stock at 105, but remember, you only paid $90 for it, so you have a $15 per share profit, okay? Now, if we add we'll call that CG for capital gain, if we add that $15 to the $1 that you got in option premium, that means that you cleared $16 per share on this deal. Now that's not too bad. Had you sold this stock at $100 when it was stuck going sideways, you would have made maybe $10 a share, and you also would not have had any more opportunity. But in this particular case, you lock in a higher opportunity, in this case $105 per share, plus you made some additional option premium in the process. Now, there's another way that this could have played out as well. The stock could have gone down. And if the stock had gone down, let me draw this one on the screen for you. If the stock had gone down, I'm running out of pen color, so we'll do this in red. If the stock goes down, well, you will still keep 100% of the option premium, but you will start to see negative capital gain. In other words, you're going to have an equity loss in the stock. But you realize you already had that risk. That's the exact same risk that you had already taken on when you purchased the stock itself. So what you can see from this particular layout here is whenever you buy a stock and turn around and sell a call option against it, we call that the covered call. Whenever you do that transaction, you are receiving a premium in exchange for selling your rights to the stock. Somebody else has the right to buy the stock. You're obligated to sell to them, and either you will sell at that strike price, which is going to be higher than the price that you purchased at, assuming you write that contract. When you sell at that price, then you will make that capital gain, and if you don't end up selling at that price, then you'll keep the option premium. This is a great strategy for many of you.